This video will provide an overview of the key concepts covered in Chapter 13, Financial Futures Markets. Financial futures markets facilitate the trading of financial futures contracts, which are traded in order to speculate on or hedge against the movement in specific security or commodity prices. These markets are commonly used by financial institutions and other corporations to reduce their risk. Chapter 13 includes 5 learning objectives. First, to provide a background on financial futures contracts. Second, to explain how interest rate futures contracts are used to speculate or hedge based on anticipated interest rate movements. Third, to explain how stock index futures contracts are used to speculate or hedge based on anticipated stock price movements. Fourth, to describe the different types of risk to which traders in financial futures contracts are exposed. And fifth, to describe the international aspects of financial futures trading. Let's start with some background on financial futures. A financial futures contract is a standardized agreement to deliver or receive a specified amount of a specified financial instrument at a specified price and date. There are 2 popular types of futures contracts: interest rate futures and stock index futures. Interest rate futures contracts are on debt securities such as treasury bills, treasury notes, treasury bonds, and Eurodollar CDs. Stock index futures contracts allows for the buying and selling of a stock index for a specified price at a specified date. Markets have been established to facilitate the trading of futures contracts. Futures exchanges provide an organized marketplace in which standardized futures contracts can be traded. Some specialized futures contracts are sold over the counter rather than on an exchange, whereby a financial intermediary such as a commercial bank or investment bank finds a counterparty or serves as the counterparty. These OTC arrangements are more personalized and can be tailored to the specific preferences of the parties involved. Financial futures are traded to either speculate on prices of securities or to hedge existing exposure to security price movements. Speculators in the financial futures markets take positions with the goal of profiting from expected changes in the price of futures contracts over time. Day traders attempt to capitalize on price movements during a single day. Usually they close out their futures positions on the same day the positions were initiated. Position traders maintain their futures positions for longer periods of time, such as weeks or months, and attempt to capitalize on expected price movements over a more extended time horizon. Hedgers take positions in financial futures in an effort to reduce their exposure to future movements in interest rates or stock prices. Financial institutions generally use futures contracts to reduce risk. This exhibit summarizes how various types of financial institutions participate in the futures market to protect themselves against a possible increase in interest rates, thereby insulating their long-term debt securities from interest rate risk. To buy or sell futures, customers open accounts at brokerage firms that execute futures transactions. Customers can either place a market order or limit order. The futures exchange facilitates the trading process but does not itself take buy or sell positions on futures contracts. Instead, the exchange acts as a clearinghouse by recording all transactions and guaranteeing timely payments. The next learning objective relates to interest rate futures contracts. Interest rate futures contracts specify a face value of the underlying securities, a maturity of the underlying security, and the settlement date when delivery would occur. The price of an interest rate futures contract generally reflects the expected price of the underlying security on the settlement date. Participants in the Treasury bond futures market closely monitor economic indicators that affect Treasury bond prices, such as economic growth, employment, gross domestic product, retail sales, industrial production, and consumer confidence. Speculators who anticipate future movements in interest rates can likewise anticipate the future direction of Treasury security values and therefore predict how valuations of interest rate futures will change. This exhibit illustrates the potential payoffs from speculating in futures contracts. The graph on the left represents a purchaser of futures, and the graph on the right represents a seller of futures. The S on each graph indicates the initial price at which a futures position is created. The horizontal axis represents the market value of the securities in terms of a futures contract as of the delivery date. The maximum possible loss when purchasing futures is the amount to be paid for the securities, but this loss will also occur only if the market value of the securities falls to 0. The amount of a gain or loss to a speculator who initially purchased futures will equal the loss or gain to a speculator who initially sold futures on the same date. Because investors commonly use a margin account to take futures positions, the return from speculating in interest rate futures should reflect the degree of financial leverage involved. Most buyers or sellers of financial futures contracts do not actually make or accept delivery of the financial instrument. Instead, they offset their positions by the settlement date. Financial institutions can classify their assets and liabilities in terms of their sensitivity of their market value to interest rate movements. Over the long run, an institution may attempt to restructure its assets or liabilities so as to balance its degree of rate sensitivity. However, restructuring the balance sheet takes time. Therefore, in the short run, the institution may consider using financial futures to hedge its exposure to interest rate movements. Financial institutions commonly take a position in interest rate futures to create a short hedge, which is the sale of a futures contract on debt securities or an index that's similar to the institution's assets. The short position from the futures contract is taken to hedge the institution's long position in its own assets. When considering the rising and declining interest rate scenarios, the advantages and disadvantages of interest rate futures are obvious. Interest rate futures can hedge against both adverse and favorable events. This exhibit compares two probability distributions of returns generated by a financial institution whose liabilities are more rate sensitive than its assets. If the institution hedges its exposure to interest rate risk, its probability distribution of returns is narrower than if it does not hedge. The return when hedging would have been higher than the return without hedging if interest rates increased, the left side of the graph, but lower if interest rates decreased, as illustrated on the right side of the graph. Some financial institutions use a long hedge to reduce exposure to the possibility of declining interest rates. These contracts lock in the price at which Treasury bonds can be purchased, regardless of what happens to the market rates prior to the actual purchase of the bonds. Because interest rate futures contracts entail transaction costs, they should only be used to hedge net exposure, which is the difference between asset and liability positions. Now let's move on to stock index futures. A futures contract on a stock index is an agreement to purchase or sell an index at a specified price and date. The value of the stock index futures contract is highly correlated to the value of the underlying stock index. However, the value of the stock index futures contract commonly differs from the price of the underlying asset because of some unique features of the stock index futures contract. Because stock index futures prices are primarily driven by movements in the corresponding stock indexes, participants in stock index futures monitor indicators that may signal movements in the stock indexes. Stock index futures can be traded to capitalize on expectations about general stock market movements. Speculators who expect the stock market to perform well before the settlement date may consider purchasing S&P 500 index futures. Conversely, participants who expect the stock market to perform poorly before the settlement date may consider selling S&P 500 index futures. Stock index futures are also commonly used to hedge the market risk of an existing stock portfolio. A hedge based on stock index futures is more effective when the investor's portfolio, such as the S&P 500 index, is diversified. The value of a less diversified portfolio will be less correlated with the S&P 500 index, in which case a gain from selling index futures may not completely offset the loss in the portfolio during a market downturn. Portfolio managers do not necessarily hedge their entire stock portfolio because they may wish to be partially exposed in the event that stock prices rise. This exhibit illustrates the net gain, including the gain on the futures and the gain on the stock portfolio, to the portfolio manager under 6 possible scenarios for the market return. If the stock market declines, any degree of hedging is beneficial, but the benefits will be greater if a higher proportion of the portfolio is hedged. Institutional investors are increasingly using dynamic asset allocation, in which they switch between risky and low-risk investment positions over time in response to changing expectations. In some periods, the prices of stock index futures may differ significantly from the prices of the stocks represented by the index. Some securities firms watch for such discrepancies and act as arbitrageurs, using a strategy known as index arbitrage, which involves buying or selling stock futures while simultaneously taking the opposite position in the stocks represented by the index. As we saw in Chapter 12, circuit breakers are trading restrictions imposed on specific stocks or stock indexes. By prohibiting trading for short periods of time when prices decline to specific threshold levels, circuit breakers may allow investors to determine whether circulating rumors are true and to work out credit arrangements if they have received a margin call. Now let's consider the risk of trading futures contracts. Market risk refers to fluctuations in the value of the instrument as a result of market conditions. Firms that use futures contracts to speculate should be concerned about market risk. Basis risk is the risk that the position being hedged by the futures contracts will not be affected in the same manner as the instrument underlying the futures contract. This type of risk applies only to those firms or individuals who are using futures contracts to hedge. Liquidity risk refers to potential price distortions due to a lack of liquidity. Credit risk is the risk that a loss will occur because a counterparty defaults on the contract. This type of risk exists for over-the-counter transactions in which a firm or individual relies on the creditworthiness of a counterparty. Prepayment risk refers to the possibility that the assets to be hedged may be prepaid earlier than their designated maturity. Operational risk is the risk of losses as a result of inadequate management or controls. And finally, to the extent that traders of financial futures contracts or other derivative securities are unable to cover their derivative contract obligations in over-the-counter transactions, they could cause financial problems for their respective counterparties. This could expose the futures market to systemic risk, whereby the intertwined relationships among firms may cause one trader's financial problems to be passed on to other traders if there's not enough collateral backing the contracts. The last learning objective in the chapter relates to the globalization of futures markets. The trading of financial futures also requires the assessment of international financial market conditions. Financial futures contracts on U.S. securities are commonly traded by non-U.S. financial institutions that maintain holdings of U.S. securities. These institutions use financial futures to reduce their exposure to movements in the U.S. stock market or interest rates. Foreign stock index futures have been created both for speculating on and for hedging against potential price movements in foreign stock markets. Expectations of a strong foreign market encourage the purchase of futures contracts on the representative index. Conversely, financial institutions with substantial investments in a particular foreign stock market can hedge against a potential temporary decline in that market by selling foreign stock index futures. Finally, a currency futures contract is a standardized agreement to deliver or receive a specified amount of a specified foreign currency at a specified price or exchange rate and date. Some companies act as hedgers in the currency futures market by purchasing futures on currencies that they will need in the future to cover payables, or by selling futures on currency that they will receive in the future. Speculators in the currency futures market may purchase futures on a foreign currency they expect to strengthen against the US dollar, or sell futures on currencies that they expect to weaken against the US dollar.